Hello, good afternoon. You're watching Closing Trades on ET now. I'm Anisha Jain. With me is Aisha Faridi in midst of the earnings season, and they have been a bit mixed. Today, you of course have the numbers coming in from BHL at the bottom of the screen. The profitability has come in double digit in terms of the crores, less than 100 crore rupees, though revenue is around 6,600 odd crores. So we're watching out for that. For now, the stock has shot up suddenly 7 to 8%. But that's been the nature of this market. We have seen very good, thumbs up coming in for good reactions and good earnings, while very negative for the ones which have managed to miss the street estimates. Case in point being the likes of Arvind today. Arvind Limited has seen quite a bit of gain. Look at that, 17% higher. First Source, which has managed to raise the guidance quite meaningfully, is also sitting in double-digit gains, and then Bandhan Bank is also up 9 to 10%. On the weaker side, Interglobe is getting a bit of a drubbing in the trading session. Chola Invest is in the red, and then Coal India continues to be under pressure. Having said that, Nifty overall has managed to bounce back quite nicely. It's likely to close in the positive if it continues the momentum like this, and this will be after 5 consecutive days of decline that we will be seeing a bit of a positive closing. So will be interesting to track the last 1 hour of the trading session. It's PSU Banks which is leading the rally today. Metals are doing well. Within PSU banks, a couple of earnings had come by and they were positive, whether PNB or Indian Bank, etc. And all of that is having an impact. But for now, let me toss it across to Nikunj, who's in conversation with Prashant Jain.
Everybody really looks forward to is our Diwali interaction with Prashant Jain to understand his insights, where he expects there could be value migration in this market, where there are excesses in the market, and what about valuations and the earning mix. All that and much more on this Diwali special with none other than Prashant Jain. Mr. Jain, first Diwali greetings to you and your team. The current Samvat year, even though last couple of days have been quite volatile and choppy, in general is a Samvat where massive wealth has got created in equities, real estate, and also gold.
Yes, Nikunj, you are absolutely right, and I wish you, your colleagues, and your viewers a very happy and prosperous new year ahead as well. And I would agree with what you said, though the current year looks to be one of moderation, and I think it is always good to have a moderate year after strong wealth creation, and it sets the base for future returns. So I think I would echo your sentiment, yes.
Mr. Jain, you've been a big votary of mean reversion over the years. The way you've managed money both publicly and now for your private clients, you've always said that markets, they follow a cycle. Cycle means that there is mean reversion. If one has to assess this bull market cycle, where are we in this cycle? Are we anywhere closer to euphoria, bubble and a bust, or we are nowhere close to that part of the cycle?
I think, Nikunj, I think it would be unfair to answer this question for whole markets because there has been considerable divergence between large caps and small mid caps. So I would say in large caps, we are very close to fair value. I think there is very little room, probably no room for multiples to move up. But I think we can by and large justify these multiples in aggregate terms for the large caps. I think the challenge for the markets, as me and many others have been highlighting for a while, is in the small and mid caps. And that is the space, I think, which is clearly ahead of fundamentals. The multiples are extremely rich. And I think in many places, the earnings will disappoint. So the downside in those spaces is what appears to be more. The risk reward is clearly in favor of large caps, in my opinion.
So are we going to go through that phase that for last 3 years we've used the word a secular bull market? It was a rising tide phenomenon. Now it is going to be a differentiated not delivering. Within IT, the same trend. Within auto, the same trend. Are we going to go through what really could be called as a market where a bull market and a bear market, they would coexist? Within a sector, some banks are delivering, some banks are. Non-secular bull market where very few stocks will go higher.
Yes, I think Nikunj, the dispersion in future performance should be probably more in these markets because valuations are by and large quite reasonable, not much upside. In aggregate terms, multiples are fair. But I think as results come out, as growth disappoints or is in line or exceeds expectations. I think the divergence in performance across sectors and across individual businesses could be more going ahead. You are right.
What do you make of the current leg of the earnings season? We are getting more downgrades, hardly any upgrades. Even though economy is growing at 8%, there seems to be a struggle when it comes to individual companies, and the kind of commentary we are getting from autos to FMCG, from consumer to even consumer discretionary, all companies are now struggling. Why is that? If the economy is growing, then why why earnings are contracting?
But I think there can be some differences between economic cycle and business cycles, and that is what we are experiencing here. And we have actually been sharing, suggesting that the profit growth rates need to come down very sharp. See, there are two things here. One, the overall economy, while the real growth is 6 to 7%, India is now a lower inflation economy. So our inflation is broadly 4 to 5%. So which means your rupee GDP, nominal GDP is growing around 10-11% a year. So longer term earnings need to align with that lower inflation environment, lower nominal GDP growth rates. The last 5 years earnings were supported massively because corporate profitability base or margins were extremely low post COVID. We have seen a complete recovery in corporate profitability, in corporate margins. Our aggregate corporate profitability is very close to previous peaks. So I think future profit growth to margin upside appears to be limited, especially in most of the sectors. So I think in aggregate terms, one would expect profit growth to be around 12 odd percent over next few years. I think regarding the sectors which you mentioned, consumer-oriented sectors, I think what one has seen over last few years, and we have written about this also, that the consumption in last few years was supported by rising retail leverage, by rising household leverage. And I mean, it's very logical whenever you borrow and spend, at some point in the future, you have to slow down. So I think that is the phase that what we are experiencing. I would not worry too much about this from a medium term perspective, but near term, you are right that the consumer demand appears to be somewhat weak.
The script of how Indian markets have moved has been deeply influenced by local flows, be it HNI investors, family office, or the SIP investors. When you have such a large inflow, which looks like is a committed flow for in the near term, how do you see market reacting? Because even though FIs are selling, the local flow is making all the difference.
No, you are right, absolutely, Nikunj. But what you also need to add to that equation is the supply of new stock. So the IPOs, the NFOs, the sell downs, I think is very significant. It is very large, and you are seeing multiple billion-dollar IPOs getting concluded in the recent past. In the future, many are in the pipeline. So I think, and that is so the source of supply is twofold: the foreigners and the new stock supply. And this is the reason why I think markets have corrected.
You've been echoing your thoughts on small and mid cap. It's taken almost a year for markets to realize that there was euphoria and bubble there, and now these stocks have started correcting. Where are mid caps headed? And within mid cap, where do you think the vulnerability to valuation is the highest?
I think, Nikunj, I think, yes, we have experienced this many times in the past also, that what is expensive can become more expensive, and what is cheap can become cheaper because before mean reversion sets in. So I think the significant wealth creation, small mid caps, because of the extremely low base set during COVID, create higher wealth if measured from that point of time. And that is why a lot more people participated in that. And that is what has led to sustained outperformance. That space, I think that cycle seems to be changing now. So I would say that the multiples in small mid caps, generally speaking, see the universe of small mid caps is so large, runs into many, many hundreds of companies, probably even more. that there will always be some businesses, 1 in 10, 1 in 20, which can outperform even in this type of a market. But by and large, I would be cautious in the small mid cap space. And I think earnings can disappoint, multiples are very high, supply of new stocks by way of new companies coming to the market is also quite high. And once the momentum breaks in a place where there are excesses, valuations are ahead of fundamentals, it is unlikely that this trend will reverse in a hurry. That is what one has seen in the previous cycles.
So going by what your newsletter is and what you've been expressing, can I, before I move to themes and sectors, can I say that the prudent strategy according to you, of course each one has to look at their own risk profile, but the prudent strategy according to you is not to sell out of equities, but perhaps within equities move from small and mid cap to large cap?
So I think this is a market where one should reset one's return expectations. I think that is most important. I think if we expect low double digit returns from Nifty over 3 5 years, I think these are realistic expectations. I don't think we should continue to expect higher returns from small mid caps. That would be a wrong expectation, in my opinion. See, the way I see Indian equities, if you look at annual returns of equities, a 10 15% volatility in equities is very normal, even without anything significant happening. And once in a while, when there is a crisis year, let's say it was Lehman or 9/11 or COVID, the falls can be sharper. So I think you should invest that much in equities, remain invested, on which you can tolerate these kinds of volatility and expect. But yeah, I think the key is to tone down your return expectations. People don't get excited by a 12% CAGR in equities. But I think that's it can create significant wealth if you invest with those returns for longer periods of time. And in any case, I think those are the likely returns, in my opinion. Also, one cannot ignore the significant difference in taxation between equities and fixed income. So, at 5% post tax returns on fixed income, it will take 14 years to double your money. But in equities, I think we can probably double money, at least in large caps, over a 6 years or so, or over 14 years, and it becomes 500 in equities. I think that type of an approach, that type of expectation should be the right one for equities.
Okay, I'll now move to the next leg, and I just want to bring this out for the benefit of our viewers that I've had the pleasure of interacting with Mr. Jain for almost 2.5 decades now. His ability to really find value in this market and really ahead of the curve is quite extraordinary. For example, PSUs, corporate banks, identifying manufacturing, staying out of IT when there was absolute bubble and trouble there, avoiding mid caps in 2014-15. These have been some of his classic calls. And in COVID, well, he went all out on ET Now. I distinctly remember when he said that it's time to buy the fear because stocks were available, gold was available at the price of silver. So let's take that theme forward. Where do you think this market right now is offering value for a value investor like Prashant Jain?
Yeah, I think first and foremost, this is a market where there are, to my mind, no pockets of deep value. So up till now, what one has seen in different cycles, that some pocket or the other was deeply undervalued, whether it was non-tech in 2000, whether it was non-infra in 2007, whether it was, PSUs, corporate banks, capex, manufacturing few years back, utilities, etc. In this market, deep value is hard to come by, to my mind, and one has to be satisfied with compounding returns, as we discussed earlier. Yet, on a relative sense, I feel the banks are offering relatively better value, and that is what has been the case for some time. I think there, the while earnings growth will be in low to mid teens, I think there is some scope, a limited small scope for multiples to re-rate as well. At least the multiples don't appear to be excessive. Chances or room for a de-rating in multiples is probably not there. So I think that would be the most preferred place to my mind.
But if the economy slows down, is it a good idea to buy into banks? Because there are cracks which are opening up, be it private banks or small banks or even banks which have exposure to microfinance. Without getting into specifics of names here, but the banking numbers so far have not really been extraordinarily satisfactory. They are feeling the heat of the economic slowdown.
So I don't think the economy is slowing down, but I do feel that consumption is a bit slow. And at some point, it was bound to happen because household leverage has gone up significantly. And even the central bank is somewhat concerned with that. And you are right, when consumer leverage is high, the most vulnerable pockets of consumer lending will suffer some slippages. So we are seeing some higher slippages in MFI loans, in unsecured personal loans, in credit card loans. So I would prefer the large banks where the exposure to these segments is extremely small.
That there's continuous FI selling and FI largely have a large exposure to banks. Could that be a limiting factor? And also Manish Chokhani of Inam told me that financials have a combined market cap of $1 trillion in a market which is about $4.5 trillion. Won't that be a concern? Because if this sector is already commanding a jumbo market cap, then it will be difficult for this sector to go against the FI selling.
Oh, you are right, and the FI selling has been going on for a few years now. Which so this was the most popular, the most overowned sector in India for many, I would say, probably few decades. And but we have seen considerable sell downs happening in this space, and so I still feel that if you take a slightly longer term view, this space has see uh, re- the derating of the sector has taken place because of two reasons. One, growth has slowed down, and there has been consistent selling by foreign institutions. But today's valuations, I think, align well with the current or likely growth rates of this sector.
Back with closing trades right here on ET now, and the Diwali week has started with some amount of glitter out there. We are managing to hold on to the green. In fact, now almost touching the 24,400 print. Shriram, Adani Enterprises, Eicher, M&M and ICICI Bank were just powering ahead, a good 3% after a fabulous set of numbers. But a lot of other news flow as well. We've been flagging off how ITD cementation has been in focus. The promoter, remember, is looking to sell that 46.64% stake in the company to Adani Group's Renew Exim DMCC. So let's try and understand a little bit better about this deal. We have with us Mr. Prasad Patwardhan, the CFO at ITD Cementation, joining in on the show right now. Mr. Prasad, great to have you on the show. Firstly, help us understand what's the rationale behind selling the controlling stake in the company.
Thank you for having me on your show. Well, this is a decision that the promoters, the earlier promoters, took about 2-3 months back. And at that time, we intimated the stock exchanges that our promoters were looking for an exit. And this is a culmination of that initiative, which began about 2-3 months back.
Is it that the value on the table was lucrative, or is that the interest of the business has moved out?
Well, it would not be proper for me to comment on it. It is the promoters who have decided to exit and sell their stake in the company. So, there's nothing more that I can share with you beyond what I've just said.
Okay, point taken. But what happens to the management team? Does that also get a rejig? Are you putting, is there any member of the Adani Group that will be taking the leadership position? How's the board construct going to change?
Well, it is too early to tell at this stage whether there will be changes at the board level or the management level. My own perception is that only the management of the company may not see any significant change, but it is finally for the new promoters to take a call on, how things will change going forward.
Why was the deal done at 200 rupees a piece when the trade 400 rupees a piece when the share is trading at around 530 rupees? Why such a major 25% discount?
Well, again, it would not be proper on my part to comment on this. This is something that which the buyers and the sellers have agreed to. So it's best left for them to respond to these queries. It will not be right on my part to comment on this.
Is understand, but it's just something of importance and significance for the minority shareholders who are watching it. So they might have appreciated some sort of clarity if they could get on it as to, what's the reason why the deal was done at a lower price versus than what it is being traded at.
No, as I said again, this is something between the buyers and the sellers, and I would not like to comment on it.
On the business front, how's the overall order inflow of late, sir, and what's been the pipeline looking like?
Well, the pipeline is looking pretty healthy. In fact, during this financial year, we saw a little bit of a lull before the election. The Lok Sabha election results were announced. But subsequently, we have already received orders worth about 3,800 crores in the last 2-3 months. And the order pipeline is pretty healthy. There are a lot of projects that are coming up for tendering, and we are bidding for those projects. We are also looking for opportunities outside, somewhere in the Middle East or Oman as well. So the bidding pipeline looks pretty healthy, and we are pretty confident that we'll get more projects in the remaining part of this financial year.
What are you hoping to close the full year in terms of margins with? Can you exceed 12 to 13%?
Well, no. In the first quarter, we have reported about 10 plus, but there could be some improvement in the margins. I mean, it will incrementally, we'll see a movement in the margins on a slower basis. I mean, if we reported 10% in the previous quarter, it's not going to jump to 12 or 13% within the same financial year. But we are hoping for some improvement in the margins as the economies of scale keep kicking and the revenue of the company also keeps growing. So there will be some incremental improvement in the margins, but difficult to comment at this stage.
Do you have any inclination on, how much time the deal with Adani is going to take? What's the, completion timeline like?
Well, there are certain regulatory and other approvals that need to be taken, and difficult to estimate a timeline for that. But my guess is it should happen in the next couple of months or so.
Okay, point taken. On that note, sir, we let you go. Thanks so much for making time and speaking with us today. We'll get more clarity perhaps when the deal closure actually happens, and we can reconnect then. Time now to actually take it across to Prakash, because metals pack as a whole has been doing quite well, and one of the stocks which has been leading the rally is NMDC, and this is an exclusive that we are picking up from sources that Center may be looking at merging KIOCL with India's largest iron ore merchant miner, which is NMDC. They have come out with a clarification as well, so let's take it across to Prakash to get more details on this one. Prakash.
Yes, sir. We're given to understand that the government is looking at the possibilities to merge KIOCL with the NMDC, a very significant development coming in, as we are learning from our sources that the Steel Ministry is working on a detailed proposal. A lot of other factors are being taken into consideration, and the proposal will be finalized after assessing the viability of the merger. Along with that, sources are also informing that this proposal is being prepared on the back of KIOCL facing difficulties in commencement of mining operation. At this point of time, KIOCL has no captive iron ore mine to operate its pelletization plant in Mangalore. Therefore, the company has already leased a pellet plant to NMDC. Our Steel Ministry sources are of the view that if NMDC takes over the plant, that will make a sense, as it will be using its own iron ore going forward, and that will bring down the cost of operation for the plant. A very significant development coming in, as this decision will be mutually beneficial for both these companies. Therefore, Steel Ministry has started working on a detailed proposal. In fact, Ministry is also seeking views from both the companies, and then the final proposal will be sent to the Finance Ministry for its consideration.
Okay, Prakash, we leave it at that. That's the exclusive info we're picking up on, and holding up well. A good 200 points up in the green for the index alone. Good market breadth. We'll bring on board our chartists on the other side of this break.
If you like this video, then like, share and subscribe to ET Now.